In times of economic uncertainty, every investor starts to feel the tension between fear and strategy. The headlines scream about inflation, layoffs, and volatile markets, but smart investors know that recessions don't destroy wealth. They simply transfer it from the unprepared to the prepared. Building a recession-proof portfolio before 2026 isn't about chasing hype or timing the market. It's about making calm, calculated moves that strengthen your financial position, protect your assets, and create a foundation that can withstand any economic storm. 10. Build a solid emergency fund. Every resilient portfolio begins with cash. A strong emergency fund acts as your first line of defense when financial chaos strikes. Aim to hold at least 6 to 12 months of living expenses in an easily accessible account, something not tied to the stock market. This fund ensures that when markets crash, you won't have to sell valuable assets at a loss just to cover bills. It gives you flexibility, mental peace, and time to make thoughtful decisions. 9. Focus on defensive and essential sectors. Recessions punish luxury spending, but reward necessities. Defensive sectors like healthcare, utilities, and consumer staples rarely see massive downturns because people continue to buy food, medicine, and electricity even during economic slumps. Allocating part of your portfolio to these essential industries provides consistent dividends and stable demand. Unlike speculative growth sectors, these businesses maintain profitability even when confidence falls. 8. Diversify across multiple asset classes. Diversification is the quiet genius behind every strong portfolio. When one market suffers, another can cushion the blow. Spread your wealth across different asset classes: equities for growth, bonds for stability, real estate for tangible value, and perhaps commodities like gold or silver as inflation hedges. In an unpredictable economy, no single asset can carry your future. True diversification ensures you don't rely on one basket of eggs. 7. Prioritize quality over hype. In booming markets, hype rules the game. But in recessions, quality is what survives. Seek companies with strong fundamentals, low debt, steady earnings, positive cash flow, and management you trust. Avoid high-risk startups or speculative investments that promise fast returns but lack stability. Blue-chip stocks and established businesses may grow slower, but they rarely collapse. Quality investments compound quietly over time and reward patience. Remember, when fear dominates the headlines, true strength lies in fundamentals, not fads. 6. Keep a long-term mindset. When markets plunge, emotions rise. Investors panic, sell off, and lock in losses. But those who remain patient and disciplined are often the ones who profit when recovery begins. Recessions are temporary, but the wealth built from consistency lasts decades. Stop checking your portfolio daily and start focusing on your horizon. History shows that markets rebound stronger after downturns. By staying invested and keeping faith in your long-term strategy, you allow compounding and time to rebuild your growth naturally. 5. Strengthen your bond holdings. In uncertain times, bonds are your financial seatbelt. They don't deliver the thrill of stocks, but they offer stability and protection. Government and high-grade corporate bonds provide fixed income and often perform well when equities falter. The key is balance. Don't overcommit, but ensure a solid allocation that suits your risk tolerance. Consider laddering your bonds across different maturities for steady returns. As volatility rises toward 2026, bonds anchor your portfolio, shielding your capital and ensuring predictable cash flow. 4. Maintain cash for strategic opportunities. Smart investors know that recessions are also clearance sales for assets. When others sell in panic, those with cash on hand can buy quality investments at deep discounts. Maintaining liquidity allows you to seize those rare market moments that define long-term wealth. Keep a portion of your portfolio in cash equivalents, like money market funds or short-term treasury bills. When fear grips the market, patience and liquidity become your ultimate superpowers. The brave may act fast, but the prepared act wisely. 3. Avoid high debt and risky speculation. Debt becomes toxic when the economy tightens. Companies with high leverage struggle to stay afloat, and investors relying on borrowed money face margin calls. Reduce exposure to businesses burdened by heavy debt, and never depend on leverage to chase returns. Personal debt is equally dangerous. Pay off high-interest loans before they erode your stability. Speculative assets might look tempting, but they're often the first to crash in downturns. Avoid chasing what's popular today. Build around what endures tomorrow. 2. Rebalance and reassess regularly. Your portfolio isn't a set-and-forget system. It's a living structure that needs tuning. Economic shifts can throw your allocations out of balance. If stocks surge, they may now form too much of your portfolio. If they fall, bonds might dominate. Rebalancing means adjusting back to your ideal risk level. Review your portfolio quarterly or semi-annually, making small strategic changes. This discipline keeps your strategy aligned with your goals, ensuring you're always positioned to grow from a place of balance, not luck. 1. Invest consistently, even during fear. The most powerful investment strategy isn't timing, it's consistency. Regular investing, especially during downturns, captures opportunities others miss. Buying when prices are low sets the stage for future growth. Stay disciplined with automated contributions. Ignore emotional noise and trust your long-term vision. Every bear market has eventually given rise to a stronger bull run. Those who invest through fear, not flee from it, are the ones who achieve true financial freedom when the dust settles. A recession doesn't have to be a financial nightmare. It can be the beginning of your strongest investment chapter. Building a recession-proof portfolio before 2026 is about clarity, balance, and courage. Stay informed, stay patient, and keep your money working wisely even when the world looks uncertain. If you found value in these strategies, make sure to like this video, subscribe for more insights, and share it with someone who's ready to invest smarter and live more securely. Your best financial future begins with the decisions you make today.